welcome to KEC International Limited Q1 FY2024 results conference call. We have with us today from the management, Mr. Vimal Kejriwal, Managing Director and CEO, and Mr. Rajiv Agrawal, CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vimal Kejriwal. Thank you, and over to you, sir.
Thanks, Nirav. Good morning. We welcome you all to the Q1 earnings call of KEC. Let me start with an update on the key developments during the quarter and thereafter talk on the overall financial performance of Q1 along with highlights of the respective businesses. We continue to deliver a sequential improvement in EBITDA margin quarter over quarter. The margin has improved sequentially by 140 basis points in the last 3 quarters from 4.4% to 5.8% and has improved by 70 basis points from 5.1 in Q1 last year to 5.8% this quarter. In SAE, I am pleased to share that we have successfully revived the business by delivering a positive PBT for the quarter. We continue to refinance the high-cost loans in tranches and are on track to refinance the balance loans. The business continues to witness a sustained flow of orders from Americas with YTD order intake of over 350 crores, a healthy growth of 65% Y-on-Y. With this, the book and L1 in SAE stands at over rupees 1,600 crores, comprising of orders of supply of towers, hardware and poles. In Afghanistan, we have realized further collections of 220 crores till date in FY24. With this, the total collections received in the last 2 quarters stand at over 260 crores. We are in active discussions with the multilateral funding agencies for collection of the balance receivables and are confident of realizing the balance in the coming quarters. Coming on to the financial performance for Q1. We have delivered a robust revenue growth of 28% for the quarter with revenues of 4,244 crores. This growth is backed by healthy execution in both T&D and our civil business. We have also achieved an impressive growth in EBITDA of 45% with a consolidated EBITDA margin of 5.8% for the quarter. We are, however, witnessing a shift in the margin profile with a significant improvement in revenues and margins of our UAE subsidiaries, SAE and KEC Spur. The margins for the standalone are slightly lower owing to the mix of projects under execution during the quarter. We have also increased our bottom line significantly with PBT growth of 26% and PAT growth of 36%. We continue to witness an uptake in order intake. Along with our Q1 results, we have also announced new order wins of 1,065 crores yesterday. These include orders in the T&D and cable business. With this, our YTD order intake stands at rupees 4,500 crores, a staggering growth of 30% vis-a-vis last year. The largest contributors in our YTD order intake have been India T&D and civil businesses, followed by railways and cables. We now have a well-diversified and strong order book of rupees 30,125 crores as on 30th June 23, a robust growth of 27% vis-a-vis last year. Additionally, we have an L1 position of over rupees 5,000 crores diversified across businesses. With this, our order book plus L1 position stands at a record level of over rupees 35,000 crores, which is more or less equally divided between the T&D and the non-T&D businesses. We continue to focus on working capital and have brought down our net working capital by 22 days to 126 days as on 30th June 23, vis-a-vis 148 days as on 30th June 22. Our net debt, including acceptances, have reduced by more than 350 crores and stand at rupees 5,714 crores as on 30th June 23, despite a revenue growth of 25% in the trailing 12 months. The interest cost, however, stands at 3.7% of revenue, owing to the steep increase in the interest rates. Now coming to the specific businesses. Our T&D business has achieved revenues of rupees 2,188 crore with a significant growth of 33% vis-a-vis Q1 last year. The growth has been delivered on the back of robust execution across both domestic and international markets. In terms of order intake, the business continues to witness traction with a stellar growth of 50% and new orders of over 1,800 crores across India, Middle East, Africa, Europe, and Americas. We are pleased to share that the business has secured prestigious repeat orders from private developers and another order from a reputed power generating client. In a significant achievement, the business has secured its maiden tower supply order from Europe, which is a testament to our dedicated focus on increasing the tower sale business and diversifying it geographically. We have also secured our second tower supply order from the US market. The overall tender pipeline in T&D continues to be strong both in domestic and international markets. In India, the power sector is poised for promising growth with transmission infrastructure planned for major renewable energy potential zones such as Rajasthan, Gujarat, Andhra Pradesh, and Tamil Nadu to support the target of achieving 500 gigawatt of non-fossil fuel power by 2030. We have already secured some of these orders in the T&D segment. We have also increased our focus on the renewable energy segment, especially solar. In international, we continue to witness opportunities in the Middle East, SAARC, and the CIS region. With a record order book and L1 in T&D of over rupees 18,000 crores and an increase in tendering activities across regions, the business is expected to gain further momentum. Coming to railways, the railway business has clocked a revenue of 764 crores for the quarter with a growth of 8% vis-a-vis Q1 last year. The business has also secured orders of over rupees 750 crores, strong growth of over 80% vis-a-vis last year. In a significant development, the business has successfully expanded into the international market with its order for a signaling and telecommunication project in Bangladesh. In line with the government's focus on increasing capacity, speed, and safety of the Indian railway network, the business has forayed into the emerging segment of automatic block signaling ABS to increase line capacity through automation and thereby strengthen its presence in the promising speed upgradation segment. With increased thrust of the government on strengthening the infrastructure, we expect some large opportunities in the areas of signaling and telecommunication, speed upgradation, PCAS, that is Kavach, and automatic block signaling. We also continue to focus on the international market. Our civil business continues to be on a high growth trajectory as it delivered revenues of over rupees 950 crores, a splendid growth of 60% vis-a-vis Q1 last year. The growth has been delivered by robust execution across all segments, especially industrial, urban infra, water, and residential. During the quarter, the business has strengthened its order book with multiple orders of rupees 1370 crores in the industrial, residential, and commercial building segments from reputed clients. The business has also widened its presence by securing composite orders including mechanical, electric, and plumbing works MEP. The data center industry in India is witnessing unprecedented development and is one of the fast-paced growth sectors. It is estimated that there will be an addition of over 800 megawatt capacity by 2024 with an investment of $5.5 billion in setting up data center facilities. We are currently executing 4 data center projects and are confident of growing this segment significantly. With a robust and diversified order book and L1 of over rupees 11,000 crores, the civil business is confident of leveraging upcoming growth opportunities through its diversified presence across sectors and strong project management and execution capabilities. In oil and gas pipelines, the business has delivered revenues of rupees 104 crores, a growth of 13% vis-a-vis last quarter. The business continues to focus on building required pre-qualifications to increase the size of the addressable market. The business has a strong order book and L1 of rupees 1,000 crore, comprising government and private players. We are confident of scaling up this business in the coming years. Our cables business has achieved revenues of rupees 389 crores. During the quarter, we have launched a large transformation program for improving profitability with a global management consultant. The business has successfully ramped up the PVC plant to produce 500 metric tons of various grades, thereby leading to a significant cost advantage and better control on the supply chain. The business is also progressing well with the development of additional new products and is on track to commercialize them this year. In ESG, we continue to embed industry-leading practices across our operations in factories and project sites. In line with our strategy to make all our manufacturing plants water positive, we are pleased to share that our Nagpur plant recently received water positive certificate for promoting water conservation. Our efforts have led to the company generating 60% more water credits than debits. In conclusion, we are pleased with our consistent growth in revenues, traction in order intake, and improving trajectory of profitability. The outlook remains healthy across most of our businesses with the current tender pipeline of over rupees 1 lakh crores. With a robust order book plus L1 and strong focus on execution, we are confident of delivering revenues of over rupees 20,000 crores with EBITDA margins of 7% for the year. Thank you. I am now open to questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. First question is from the line of Ashish from JM Financial. Please go ahead.
Yeah, good morning, sir.
Morning, Ashish.
So my first question is on the India T&D prospects. We have seen some amount of traction picking up. So if you can specifically tell us how is the order bid pipeline at this point of time for the India T&D, and is there any number you'd like to leave us with what is the kind of inflow we expect in that business this year?
For India T&D, we are suddenly seeing a lot of traction. I think there is some change somewhere in the government thinking, saying that, notwithstanding what is happening, or let's say some delays in solar and etc., they have now said that since the transmission line takes probably 2 years, 2.5 years to erect, construct versus a solar of 1 year, they have now started going ahead with lines, even if the solar and all are slightly, I'll say, slightly behind, okay? But if you want to take some numbers, probably between PGCIL, SCB and private, we are seeing somewhere around a tender pipeline today of around 20,000 crores or so, let's say in the coming quarter or two. That's the numbers which are there today.
Okay, and what is the kind of share that we'll expect this year? And basically, what's the kind of competitive intensity? How many players are bidding today? And what's our fair share we'll expect out of this, let's say, 25,000 crores?
So, Ashish, typically, we have been getting between 10 to, I'll say, 15, 16%. So, 1 out of 6 is what typically we see, okay? That's a typical one. Competition, I'll say, in transmission line is maybe for larger projects, I'll say, would be 4 or 5 players. Substations, where we are actually getting a lot more orders in substation than in transmission, incidentally, is maybe 3 or 4 people for the larger ones, especially the GIS ones. If it's the AIS one, then the numbers are much larger, maybe 7 or 8 players. But GIS would be 3 or 4 players.
Got that, sir. One last thing. On the Dubai business, we have mentioned that it's been ramping up well. If you can give us the revenue and EBITDA that we have done in the UAE business for this quarter.
I don't think I have the exact numbers, but it would be, I think, somewhere around 700-800 crores of revenue between the two subsidiaries in Dubai. If you look at the annual numbers, Dubai plant should be around 500 crores also, between 400 to 500 crores, because the capacity is around 50,000 tons. So if you take an average realization of 1 lakh, I'll say it will be between 400 to 500 crores would be the full revenue potential of the plant. And on the EPC, it depends upon how many orders we are able to execute and what do we do. But I think typically, this quarter I don't have the exact numbers, but that's what we will achieve.
And what's the kind of margin the Dubai plant makes, sir?
So right now the margins are better than other places because of the fall in the steel prices, because these orders have been booked and, steel has been showing a beneficial trend. So I think it would be close to double digit or something, or maybe 10, 100 basis points here or there. But it will probably be around that side.
Got that, sir. Thank you very much.
Thanks, Ashish. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Vivek from DSP Mutual Fund. Please go ahead.
Sir, good morning and congratulations on an excellent performance. On the standalone EBITDA, we had said that there was a product mix that caused lower EBITDA. Which part of the product mix in terms of revenues caused the lower EBITDA, and do you expect it to normalize in the current year? Is question number one. I mean, in the later quarters. And secondly, especially on working capital, there's been tremendous improvement. You had some kind of wobbles in the railway collections. Has that improved? Those are my two questions, sir.
So the railway collection wobbles still continue. Let me be very, very clear on that. I think that's still not normalized. Partly our issues where we have not been able to, bill it properly or complete the project as per the commercial terms, and partly on account of delays. Okay. As far as the India, I'll say standalone business is concerned, I think what we had said is that the project mix was an issue because we've been discussing the legacy projects for a long time. So we have been able to book a large part of the losses in those projects during the quarter, and depending upon how they progress, probably they should get hopefully closed by Q2. So I think by Q3 we will start seeing a bump up in the standalone margins.
Excellent, sir. All the best to you.
Thanks, Vivek. Thank you.
Thank you. Next question is from the line of Riya Mehta from Equitas Investments. Please go ahead.
Thank you for giving me the opportunity. My first question is in regards to international T&D. What kind of, you said in Middle East and SAARC are you seeing? So what kind of opportunities are we seeing there?
So as far as Middle East is concerned, the maximum, I'll say tenders are coming in from Saudi, a few from UAE and a few from Oman, but largely it's a Saudi-focused market. And the second piece, as I answered the first question, is that we are seeing a lot of inquiries for tower supplies from our Dubai plant. So typically, I think our revenues in Middle East should be close to 1,000 crores or maybe more than that for this year. SAARC, we are seeing opportunity restricted to two countries, basically Nepal and Bangladesh. Of late, with the current situation of Bangladesh, there is a little bit less, but I think Nepal suddenly it seems to have erupted with orders or tenders. So getting funding from all over the place, from Government of India, KFW, and Millennium Corporation, US. So we have seen a large number of tenders which have come out in Nepal, and I think hopefully by Q2 or Q3, many of them would be quoted and decided. So we should hopefully see a lot more orders coming out of this country. Bangladesh also, there are some tenders, but of late it's a little bit less, but I think it's a matter of time because the requirement is large. So those tenders will also come up.
Also, in civil, you said that you're seeing investments in water pipelines. So which markets are we seeing this exactly?
So this, if you ask me the segment, it is that Jal Se Nal Tak, where you are, supplying water, building tanks, water purification plants, etc., and supplying to villages. So right now we are in two states, in Orissa and MP, and we have an order book of close to 4,000 crores in this segment.
Got it. And in terms of oil and gas pipelines, could you give your outlook on that?
That business has been a little bit subdued in that sense because the number of orders and what we were expecting tenders had not come in earlier, but now we are seeing some tenders coming out. We are already L1 in two tenders, and I think a few more are coming out, but it's been in a way lower than what we had thought. Okay, but I think the government is now again talking about the gas grid, so hopefully some more tenders will come out.
Okay, I think ONGC and all this are coming up with a tender in December now.
Yeah, Riya, let's hope for the best. Thanks, Riya.
Thank you. Thank you so much.
Thank you. Next question is from the line of Bhumika Nair from DAM Capital Advisors. Please go ahead.
Yeah, good morning, sir.
Morning, Bhumika.
Good morning, sir. So the first question is, in T&D, you spoke about some 25,000 odd crores of ordering that could possibly happen this year. Just wanted to understand how is competition kind of, behaving in this space for, given that there is a decent amount of traction. Are you seeing much more players or the same 5-6 players who typically win a lot of the orders? How is that kind of scaling up?
So typically, Bhumika, for the smaller orders and for smaller KV, where the pre-qualifications are pretty relaxed, and also for AIS substation. So there we are seeing a lot of competition, I will say. 6, 7, maybe 8, 9 players also coming in. But if you look at the larger orders, where there is requirement for specialized conductors and 765 lines, etc., and also the larger GIS, like last year we got 2 digital GIS, so there were hardly maybe I think 2 or 3 players who were able to, offer those products. So for the larger ones with much more, I'll say, complex requirements, the competition is fairly limited, maybe 3 to 4 players. But on the normal ones, it's harakiri. You have 7, 8, 9 players coming in.
Okay. So, I mean, are the big margins still at, double-digit kind of levels now here, or, have they trended up, trended down? I mean, how is the trajectory out there in terms of the big margins?
So, I said typically the bid margins have started to trend up.
Okay.
Now, actually, मैं कितना realize होगा नहीं पता नहीं है, but the margins have started to trend up very clearly.
Okay, sir. So the other thing is, in civil, obviously we've seen a huge amount of traction in the last couple of years, and we've scaled up our own offerings, etc. out there. Obviously, there's a lot of capex that's happening, a lot of activity that's happening. Where do you see the order inflow for this segment in the current year, and the kind of revenues that we could possibly see out here? And from which area?
Yeah, so Bhumika, if you remember last time also we talked about it, saying which sectors and all that. So I think one is clearly the real estate, residential piece is doing very well. Okay, that's the biggest market which we are seeing. Second one is on commercial. Surprisingly, we started seeing a lot of inquiries on the commercial side, both offices as well as shopping malls, etc. Okay, so that's I'll say in the residential and commercial. On the industrial, we continue to see a lot of things from metals and mining. Okay, whether it is steel, whether it is aluminium, zinc. So we have continuous inquiries are coming from metals and mining. Of late, we got a couple of inquiries from FMCGs, which were not there at all, but now we started receiving. So I don't know whether rural demand is picking up or what is happening, but we are seeing inquiries from FMCG. Then also from data centers, as we talked about. I think broadly those are the areas where we can see, and water is continuing in any case. Okay. Not too much on the urban infra. Okay, so there seems to be some slight slowdown, at least in the sectors in which we are operating. I think broadly that's the part of civil.
Okay. And so what kind of intake we could see in this year from this segment?
So overall for civil, our target is around 8,000 crores or so. Okay, of order intake out of the 25,000 which we have for the whole company. We expect that civil should do 8,000, maybe more, but the target is 8,000.
Okay. So here in civil, just on the margin profile, we used to be at around 5%, 6% kind of margin, some time back. With this increase in terms of a very low working capital commensurately, how is this now kind of turning? I mean, with residential, etc. coming up more, are we seeing working capital going up and margins trending up? If you can just comment on both these aspects of the segment.
So working capital, Bhumika, is more involved in your urban infra and all that. Okay, residential, industrial, and all that. Typically, the working capital requirements are very low. See, I think if you look at historically, what used to happen is that you had very small contractors who did not have their own cash flows, etc. So somewhere the way the civil business is structured, especially the residential and industrial, the payment cycles are, I'll say pretty good as when I look at T&D and railways and all that. Okay, so the working capital cycle remains fairly, I'll say, benevolent for us in terms of civil. Margins have been trending upwards. Obviously, they are not still at double digit and all that, but they're slowly trending to, hopefully it should be higher teens now, but it's trending higher single digits, but it is trending upwards. It's not at 5-6 now.
Okay. Great, sir. I'll come back in the queue.
Yeah, please. Thanks, Bhumika.
Thank you, sir.
Thank you. Next question is from the line of Nikhil Kanodia from HDFC Securities. Please go ahead.
Good morning, sir. So congratulations on the morning. Some congratulations on the robust order book that you have at the record high levels.
Thank you.
So I had two set of questions. So one set is regarding your standalone and consolidated margins, and the other set of questions would be regarding your debt numbers. So on the quarter-on-quarter basis, your debt has kind of increased by 700 crores. So any light as to like what would be the reason and the guidance for the year-end debt numbers? Like, are we expecting any reduction or any addition in the debt numbers?
So Nikhil, Q on Q, first quarter over Q4 is always a phenomenon. If you look at historically also, the Q4 debt is always lower, and Q1 has always been higher. Okay, which is why we have been, because of the seasonality of this, we have always been comparing year on year rather than Q on Q, at least in our business. So I think that's why I don't read too much in the fact that the debt number has gone up Q on Q. Okay. And also that there was a 26% increase in revenue which we have had, so there will be an impact of that. Overall for the year, I don't expect too much reduction in the debt as such, because we have been talking about revenue going up from the current 17,000 to 20,000 crore plus. So a part of debt would be required to fund that revenue increase. So although I don't see the debt going up, I don't see it coming down significantly. Okay. However, what can also happen is that the net working capital, which is at today 126 or 128 days, can probably, our target is to bring it down to 110 days at the end of the year. So hopefully there should be a reduction. Also, I think looks like that we have reached a peak of the interest rate cycle. So maybe somewhere we may see some reduction happening. Or today my interest rate average has been 7.7 versus 4.4 or 4.5 in the corresponding quarter. So it's almost like 100%, sort of rate increase which has happened. But now it's peaked. So I think interest should start, coming down as a percentage of revenue. Rajiv, you want to add anything on this?
No, I think, Vimal, you have answered it well. So effectively what we should look at is NWC. NWC has been constantly coming down. It was at 148 days. Now it has been brought down to 126 days. Despite 25% increase, if you look at the last 4 quarters, there has been a corresponding increase of 25-26% on the volume. And that's a substantial number in the absolute terms. And also we are saying now we are targeting 110 days. So that is, we are going back to what we used to be, let's say in 2019, 2020. We were at about 100 days or so. So we are actually trying to go there to 100 days of NWC. And definitely, we are quite confident that we should achieve 110 days target by end of this fiscal. Thank you.
Okay. So just to clarify, you said the average rate of interest rate is 7.7 versus 4.5 the similar quarter of the last year, right?
Yeah. Yes.
Okay. And so what would be your order inflow guidance for the year?
So as we said that our target has been around 25,000 crores. So we have now announced 4,500. So around 20,000 plus should be the balance 3 quarters.
Okay. Understood. Fair point. And sir, on the margins front, we have seen some margin improvement on the standalone and the consolidated level. And you mentioned that from Q3 onwards, we could witness some bumped up margins at the standalone level. So any guidance as to when can we expect a double-digit kind of a margin at both the levels?
Double digit right now looks difficult to predict exactly when it will happen. But our guidance for the year has been that H1 should be at 6% and H2 at 8% and overall for 7%. Okay, let's wait for some more time to see exactly when we can reach double digit. But yeah, we are slowly heading towards improving the margins.
Okay, and sir, your standalone margin guidance for the year would be?
I don't think we have separate margins for standalone and this. I think we will still restrict ourselves to Concall.
Okay. And so one thing that I could see is this is my last question. Since the PAT at the standalone level was at the lowest levels. So sir, any measures that we are taking to improve the bottom line?
So I think said that earlier, because of the mix of the projects and execution of legacy projects, the PAT was lower, and also obviously the interest cost was high. So we also, I think, let me put one thing which we have not discussed earlier, is that we are seeing some strain on the supply chain in the transmission and substation, where items like conductors and transformers, etc., are having an impact on the top line, actually the revenue growth. So I think slowly these things are coming into place. So once that happens, to me, it is the function of margin is going to depend upon the revenues. Okay, so as soon as we are able to push more revenues, it will happen. That's why I said Q3, because Q2 clearly it's a monsoon quarter in India, and also this year I think the monsoons have been pretty bad. In fact, July has been sort of washout in many parts of the country. So I think from Q3 onwards we should be able to improve on all the fronts.
Okay, sir. Understood. Fair point. So those were my questions. Thank you and all the best.
Thanks, Nikhil.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Sai from Kotak Securities. Please go ahead.
Yeah. Good morning, sir. Am I audible?
Yeah, you are.
Yeah. So my first question is, the recent CEA National Committee agenda shows a pipeline of 7 trillion in transmission and distribution segment. And while it doesn't comment on the expected timeline for the same of when it would commence, how can we expect these projects to be awarded usually? As in, what timeline can we expect since the number is too big? And how are we expecting to plan our capital expenditure on the same ahead?
So typically, Sai, what we have seen is, I have not tracked for this, but typically it's around 1 lakh crores of projects come out every year. That's the way it happens. Okay. 7 lakhs may mean if you take, typically these guys take a time horizon of 5 years. So if you divide it by that, then it could be 140,000 crores. Okay. But I can tell you one thing is that we are seeing a lot more traction than before, at least on the larger projects linked to green energy. Okay. And especially between, I'll say, in Gujarat and Rajasthan. Those are 2 states where we are seeing huge amount of projects being announced. And as you are aware, government, and especially on the wind and solar, has allocated large capacities to the PSUs, whether it is NTPC or NHPC or HAVN or GIPCL. And those large projects are coming up now. And looking at what is happening on the right-of-way, etc., what government is also doing on the transmission, all that, they are actually setting up very large projects, 765, double circuit and so on, which are not required today. But I think they want to avoid the problems which they'll see in future. So it's happening more like Middle East now, where you are building in a lot of capacity. I think that's real. But again, coming back to the question, maybe 1 lakh to 1,20,000 crores annually could be the number on the entire spend.
Great. And the kind of capex we are expecting?
I don't. What do you mean by that?
As in the capital expenditure that we are expecting for the same, as in for the projects that are going to come up.
I don't have a specific number for that. No.
All right, sir. So, and also, as you have mentioned, these projects, particularly in Gujarat and Rajasthan, they are more of a renewable theme based. And given KEC also undertakes solar projects, what can we expect on the same?
So solar, we are doing one large project right now in Karnataka. It's a 600 megawatt project. We have started bidding for a few more, very, very selectively, especially where there are no modules. We don't like to take module risks. So, but of late, I think the developers have understood that they don't get good EPCs with that. So most of the large projects now, especially from the public PSUs, are coming without modules. So we have recently put in bids for 1 or 2 of them, and I think in the next month or 2, we'll be bidding for another, I'll say 2 or 3 large solar projects.
Okay, sir. Yeah, that's it from my side. Thanks a lot, sir.
Thanks, Sai. Thank you.
Thank you. Next question is from the line of Shubhadeep from Nuvama Wealth. Please go ahead.
Good morning, sir, and thank you for the opportunity.
Morning, Shubhadeep.
So my question is with regard to the TBCB pipeline that we're seeing on the T&D side of things. I think the NCT has recently approved close to 70,000 crores worth of projects which will probably get tendered out over the next few months, which also includes one large HVDC project. So with the quantum of projects that we're seeing coming up on the 765 side or on the HVDC side, do you see, KEC having an edge in terms of, let's say, winning some of these EPC orders? And also, given, again, that, the size of the projects is larger, there are a limited number of bidders, can we see, margins also tending upwards?
I think broadly, I'll say yes. Broadly, I think very clearly, if you look at the results of 765 and other projects, in fact, we are the only EPC company which is doing an HVDC project on the converter station side. On the transmission line, there are a few others also who do it, but on the substation side, we are the only one who's doing it, apart from obviously the OEMs who do it themselves. So clearly, you are right that the competition is limited, the capability is limited. So the business will definitely grow up. Margins, I don't know how much it will grow up, but as I said earlier also, the margins are tending to improve. Okay, very clearly we are seeing those things happening. The other piece, Subhadeep, is that these projects are now coming with a shorter timeline. Okay, some of them are 12 months, some of them are 15. Max, I've seen a couple of projects for 18 months. So because of which your working capital will also start improving once you have a shorter cycle projects. Which is, if you look at the current TBCB projects which have been awarded, both by private and power, we have one project from both Power Grid as well as at least 2 or 3 private sector TBCB developers. And some of the projects are, at least the last one which I took was a 10-month project. So, I think that is another thing which will help in hopefully improving our working capital, what Rajiv was talking about, reducing the NWC and all that, would also come about from these projects.
Understood. That is very helpful. And lastly, while you have given us, a guidance with regard to, let's say, our FY24 revenue and the margins, on FY25, would you, hazard a guess in terms of, the targeted top line and hopefully nearing to those double-digit kind of margins?
I think it's a bit early for that, but let me put it this way, that we have a 35,000 crores order book plus L1. Okay. So I think as far as the top line is concerned, we are, I think, I'll say reasonably well placed. Number may be a bit early to say, okay, but I think we'll have a decent number. I can only say that. Margins, again, I still not hazard a guess right now, okay, but very clearly the project mix is improving significantly. Old orders are getting over, and I think hopefully, as I said, by Q2 we should be able to get out of almost all the legacy orders. So the margins will start improving. Whether they will touch double digit or not is a matter of conjecture today. Okay, our aspiration is that it touches double digit next year, but whether we'll be able to do it or not is something which will depend upon how the metal prices and how the execution pans out. Okay, but I think it should be significantly improved. I can say that much.
Perfect, sir. Thank you so much.
Thanks, Subhadeep.
Thank you. Next question is from the line of Harsh from Yes Securities. Please go ahead.
Good morning, sir. Am I audible?
Yeah, morning, Harsh. You're audible. Go ahead.
Sir, we mentioned the collections worth 260 crores from Afghanistan in the past 2 quarters. What's the balance amount and when do we expect to receive it?
So I think that the net as per our is around 350 crores which we expect to receive. I have said that in the next few quarters we should be able to receive, and that's what we have been earlier also mentioning, that by the end of this year we should get the money. So these monies have to come from multilateral, so it's very difficult to hazard an accurate timelines. But based on our discussions with them, we do expect that by year end we should get the balance money.
Okay. Secondly, have we managed to completely execute the legacy projects in Brazil, or there is still some portion left? Can we expect the full FY24 to be PBT positive for SAE Brazil?
So as far as the legacy projects are concerned, we had completed them, I think, in Q3 last year. Okay. So since last 2 quarters we have had no EPC projects. All of them are what we call supply projects. Okay. Brazil is EBITDA positive. As I said, SAE is PBT positive. Brazil still has a very marginal, I think, negative PBT. But now that a large part of the loan has been restructured, my view is that from maybe Q2 itself, we should be PBT positive in Brazil also. Although SAE by itself has become PBT positive this quarter.
Okay, sir. Those are my questions. Thank you for the time.
Thanks, Harsh. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Anupam Goswami from Star Union Daiichi. Please go ahead.
Hi, sir. So you mentioned about your revenue targets, which is about 24,000 crores. Where do you see the proportion of H1 and H2, given there's a little, you mentioned about a little subdued demand in the Q2. How do we see the H2 compared to H1?
So, Anupam, we talk about 20,000 crores. I don't know. I have not talked about 27,000.
Okay. That's my mistake. Okay. Fine. 20,000.
And typically what we have seen is H1 is 40%, H2 is 60%. Typically that's the way it always happens. This year, because of rains, maybe a couple of percentage points here and there, maybe 37, 38, or I don't know, but typically it's around 40 and 60. Okay, generally if you look at it in a different fashion, it's first 3 quarters is 20% and the last quarter is 40%. That's the way. So there are the two, I'll say, numbers the way we look at it. Okay.
Okay. And sir, in your margins, I was seeing in your let's say FY18 or 19, there has been a good margin growth, and one thing was there that T&D revenue mix was also pretty high in the mix. So where are we heading in the margins? Do we see T&D mix more coming in the revenue and margin also improving? Or is it like too much of a competition and we are not getting that margin profile what we used to earlier?
So, to me, Anupam, T&D margins got hit on account of two things. One was obviously because of COVID, the business had come down. And second was because of the war, the Russia-Ukraine conflict. Anupam, you'll have to either mute yourself because there's too much of disturbance from your line. So I think to me what is happening is that because of the as I said, the Russia-Ukraine conflict, the metals went up significantly. So the major reason for the reduction in the margins had been the delay on account of COVID and also the, I'll say, a very unusual increase in the metal prices over a very long period. Okay. Now to me, the metal prices have stabilized significantly. COVID has subsided, so the execution is improving. So clearly we are seeing that the T&D margins should start getting back to their normal levels.
When do we see the T&D margins?
I think we will start becoming normal from Q3 onwards is what we have talked about.
Can we expect about 11-12% in that?
I don't think we ever talked about 11-12% margins in this business. Okay. Yeah, in 18-19 we did have 10-10.5, but I think that was the maximum we have achieved till now. If we can do 11 and 12, we'll be very happy.
Okay. Okay, thank you. So I'll join back in that.
Thanks, Anupam.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Rahul Shah from Crown Capital Partners. Please go ahead.
Hello. Hi, sir. Good morning.
Morning, Rahul.
Yes. So just one question. In your exports business, so what is the contribution right now to the revenues?
So our outside India, our business is overall around 37%.
And what part of it is from non-T&D?
Right now it's 100% T&D.
100% T&D. So do you expect like non-T&D orders to be there in this year?
I just announced Railway has got our first order in Bangladesh. Civil has been quoting, oil and gas has been looking at it. So clearly the business of other verticals will definitely start increasing. Okay. And the other piece is that the India T&D is improving. So we honestly do not know where the ratios will be, and we don't have a target for the ratios. Depends upon which business does. But clearly, I think the absolute value of international business will definitely go up. SA is doing very well. As I said, Middle East is doing very well. So the numbers in the T&D as well as railway and civil will go up internationally. But I think India is doing also very well. So whether the ratios will change or not, I do not know. Because India T&D is doing well, civil is growing at 60% and all that. So the India revenues are going up significantly faster.
Right. It doesn't really matter. I mean, right. Okay. And just lastly confirming, you said net working capital days, like target is 110, right, for the year?
Yes. You're right.
Correct. Okay, sir. All the best. Thank you, sir.
Thank you, Rahil. Thank you.
Thank you. Next question is from the line of Uttam Shrimal from Axis Securities. Please go ahead.
Yeah, good morning, sir, and thanks for the opportunity and congratulations on a good set of numbers. Sir, my question pertains to interest cost. So we have incurred around 159 crore this quarter. So this run rate will go for the remaining 3 quarters also, or we expect some reduction in the interest cost going ahead?
See, our interest cost is by and large similar to what it was in quarter 4. And reason, as Vimal explained in his opening remarks, is that basically the interest cost has gone up from, RBI has front-loaded the entire interest rates hike. And in last 1 year, the RBI has hiked interest rate by almost 2.5%. So since our majority, or in fact the entire amount is towards the working capital, the transmission was immediate because all the bank borrowing in the market interest rates went up immediately on the hike announced by the Reserve Bank of India. So the entire hike has been captured in this, quarter 4 and quarter 1. More or less, our volume of borrowing has come down. In fact, if you look at last quarter 1 versus quarter 1 of last year, borrowings have come down by almost 350 crore. And so the entire impact is basically on account of the interest rate. We do expect that, these interest rates are unlikely to go down, what it looks like with the, US Fed hiking the interest rates recently, and they're talking of one more hike. We are only hoping that, RBI don't need to increase the interest rate further. So that will, we expect that by and large the interest rate will remain for the current year. Obviously, we are, making a lot of efforts in terms of controlling our borrowings and bringing down the borrowing with the revenue growth of 15 to 20% what we have guided for the year. And, I think there could be some reduction in the borrowing, and that will lead to some reduction on the overall interest rates or overall interest cost.
Okay. And sir, with regard to water projects, what kind of margins are there in the water projects that we are currently executing?
Difficult to give a specific answer because the margins depend upon the size of the project and, different values. But they would be between 8 to 10%.
Okay, sir. That's all from my side, and all the best to you.
Thank you.
Thank you. Next question is from the line of Ashish from JM Financial. Please go ahead.
Yeah, thank you for the opportunity again. Sir, my question is on the Afghanistan net receivables. So the number seems to have gone up from the March quarter to the June quarter. So have you been doing any incremental works there, or that's because of the reduction in the payables?
Actually, the second part is the reduction in the payables and liabilities.
Okay, so there's no incremental build-up of receivables, but we have unwound some of the liabilities.
We are not doing any work there, no.
Right, sir. So secondly, we did talk about Kavach as one opportunity. So is there any quantification of that opportunity at this point of time? I mean, what it means for KEC as a company for our scope of the work in that particular area?
So typically our scope of work is around 30-40% of our contract value, whatever we get. So we've got 2 contracts. So it's not very significant as of now, because I think as far as I remember, till now around 1,600 crores of tenders have come in, and we have got 2 of them. Another, I think 2,500 or so are in the pipelines. This entire Kavach, the plan which I have seen, at least talks about around 25,000 crores of orders coming over. I don't know how long it will take, but it's getting a bit expedited after the unfortunate accident. Okay. Opportunity-wise, I don't see more than 500-600 crores for this year. But if the government accelerates it, okay, then the numbers can go up. Okay. But in a best year, maybe 1,000 crores or so, if it happens. It's not a very big opportunity, but it's an opportunity where the number of players are less, so hopefully the margins can be better also.
Right. Yeah, that's also. Thank you.
Thanks, Rajesh.
Thank you. Next question is from the line of Nikhil Kanodia from HDFC Securities. Please go ahead.
Thank you for this follow-up opportunity. So just one clarification that I wanted is the yesterday's press release of 1,065 crores of order inflow, that is included in the year-to-date order inflow, right?
In the order inflow of 4,500, but not in the order book. Order book was as on 30th June. Okay.
Yeah.
Order inflow of 4,500 is year-to-date. Yeah, year-to-date.
Okay, so that includes the yesterday's order as well.
Yes.
Okay. Thank you.
Thanks, Nikhil.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Sagar Vidwania from ICICI Bank. Please go ahead.
Hello. Good morning.
Morning, Sagar.
Yeah. So my one question is regarding the standalone business. So per year-on-year basis, there is a decline from 100 CR to a mere 4 CR. So, and on the consolidated basis, there is a marginal improvement. So can you just bridge the gap between the standalone and consolidated numbers?
So, Sagar, as I said at my opening remarks, it's basically the project mix which has impacted in the last quarter. When I say Q1 of FY23, we had a very large profitable project, okay, where large revenues came in that quarter. This quarter, that project, the revenues are very less because the project is now coming to an end. Also, we had a few legacy projects where we had metal exposures, etc., which have all been hedged and booked. Plus, I'll say a couple of large legacy projects have got completed. So, and the claims are getting settled. So, based on that, whatever is the impact has been considered in the books.
Okay, sir. Thank you.
Thank you. Next question is from the line of Vishal Periwal from IDBI Capital. Please go ahead.
Yes, sir. Thanks a lot for the opportunity. Sir, one question on the Kavach. So, in terms of opportunity side, you did mention, but how exactly the bidding happened? Is it like, we as a EPC player, we bid, or the equipment player bid and then we get an order?
So, it's in I don't know whether it's a JV or a consortium, but it's a joint bid, okay, where the bids have been done together.
Okay. So, currently, can you share, how many players are there, and our tie-up is with only Carnex or anyone else also?
So, as of now, we have bid with Carnex for the 2 projects. And as far as I know, that there are 3 approved players under RDSO for the Kavach, and there are, I think, 2 or 3 more which are under approval. Okay. So, hopefully, if their approvals comes through, then you'll have around 5 OEMs, 5 or 6 OEMs in Kavach.
Okay. And one clarification. So, out of this 25,000 or 30,000 crore opportunity for EPC player, the split is 40, and for equipment manufacturer, it's 60. Is that right understanding?
It depends upon what happens, okay? We can always do more also or less. So, it's on, order-to-order basis, then who has got the financial capability to do more, etc. So, difficult to say, but right now, 40%, I think you can safely assume as a system integrator role, okay? And 50-60% would be the equipment supply. Now, that's a broad thing, but I think with the number of players and the sizes increasing, these ratios can actually undergo a change.
Okay. Sure. Thanks. That's all from my side. Thank you.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Vimal Kejriwal for closing comments.
Thank you everyone for your continued interest in KEC. Thanks a lot. Thank you.
Thank you very much. On behalf of KEC International, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.